I'm Motley Fool Chief Investment Officer Andy Cross. At our recent member event in Denver, Colorado, Motley Fool CEO Tom Gardner interviewed author and investor Michael Shearn. Michael has racked up an impressive track record thanks to his deep focus on culture and leadership.
Michael's one of my favorite investors to follow, and I first met him in Conscious Capitalism, and he has an incredible focus on leadership principles and culture, and has done a lot of original research in how to evaluate whether you have an authentic team that's trying to solve an important problem that has long-term prospects that matter versus something that might be a little bit more superficial of an effort. And so I've learned a lot from Michael, and I look forward to getting to share some of his insights with you today. I guess the first question I have, Michael, is could you just share a little bit of your journey in becoming an investor? When did you start? When did it take hold with you? And when did you really get to feeling that you're in the zone of mastery? I know you're so humble that you won't suggest that you're there, but just a little bit about the journey.
Yeah, I started reading about Warren Buffett when I was 17, so that first spurred it, and I just kind of like process-oriented things, so I've been doing it for 20 plus years now, and I started off investing in asset discount bankruptcies and special situations, and slowly just started seeing this pattern that leadership is actually what I should be looking for. And so I would say that I've evolved a lot. I used to look for bankruptcies and have just a completely different mentality to today. I'm purely looking at leaders. So that's how it's evolved.
And why did that happen? Was there an aha moment that you weren't getting the returns you wanted from distressed equities or deep turnarounds? I mean, that could be a very profitable way to invest. What unlocked focusing on leadership?
Yeah, I'd say I like to invest in chefs now, and I was investing in a lot of cooks. And what happened is that I'd have a lot of multi-bagger wins, but I'd also have a lot of losses. And over time, you're breaking even. Something about losses is one in 2008, I was down 40%. The following year, I was up 82%. And everybody thought I was a genius. And I was like, if you do the math, I just broke even for 2 years. So I started recognizing that and I've always kind of liked a certain type of leader. I felt icky with a lot of different kinds of other leaders, but I just kind of gravitated to one, and it just took me a long time to get rid of my old value investing roots.
Awesome. So we'll talk a little bit more about that, and I want to hear the icky qualities that you identify. But before we do, because you manage money, I know we have a disclaimer page that must be shown. Is that right? Or did it? It was already shown. Okay, and you were all able to read that that insect print very rapidly, assess it. Good, awesome. So you have a really interesting portfolio structure today. You own, I believe, 4 or 5 companies, so a very concentrated portfolio, and you're maybe around 30% in cash. So can you talk through how you made the decisions to run such a concentrated portfolio and to have so much cash on the sidelines as a money manager, and then what those companies are that you're invested in?
Yeah, I'd just say I'm concentrated because there's just not that many great ideas. So I've always followed the concentrated approach. The cash is just a function of we have a lot of cash on the sidelines. So the way we run it, it's 30% of the portfolio, but we have a lot of cash. And it's just dependent on how the opportunity set is. I'd love to buy a lot of these companies, but they're just not hitting my target price. But I own a Shopify, Arista, which I actually got the idea from Motley Fool. Appian is in there, and Brookfield Asset Management has been a long-term holding for me. But I'm looking for compounding machines, and the name of the fund's Compound Money Fund, and that's kind of the companies that can reinvest and grow that you can own just for super long periods of time.
So I know in 2017 you earned more than 40%. How much were you in cash during that year to have generated those returns, ballpark?
Yeah, over 25% or something like that. It's kind of but I'd like to be fully invested. I'm kind of overthinking that this cash position was from my fear of 2008 and not having any optionality. I was fully invested in 2007, and when it hit, I had to make 2 decisions. What to sell, and so I can buy something else, and so I kind of I'm rethinking this decision.
I want to just talk about each of those companies a little bit, and then really spend our time talking about how you evaluate leadership and culture. But it'll be embedded in your answers, I'm sure, as well. But let's start with Brookfield Asset Management. Why?
Yeah. It was Bruce Flatt. He's one of my criteria. I kind of have a very simple acronym I use. It's IP, and one of them up there is it's somebody that's intrinsically motivated, and that means that they're process oriented, and so. Bruce is just super disciplined. When I'd read articles about Bruce Flatt, and that's kind of how we do a lot of our research is we get historical articles. It'd be articles about him passing on a company when they bid the rival bid 50 cents more. So he had this track record of this extreme discipline and not being emotionally involved. And what I like about him is Bruce treats everybody. He's got $250 billion under management in a way, and he's just treats everyone the same, and this is a pattern I find with great leaders, is that he doesn't differentiate like, oh, this person's important, therefore I'm gonna include them. I mean, it doesn't matter who you are, he's gonna kind of treat you the same. So that makes him very accessible. And that's kind of one of the beauties I liked about Bruce.
How about Arista?
Arista, there is reading about Agni Bechtolsheim and then how he took his own money and to develop a product. And that story is what turned me on, was that basically he funded it with his own money for years before he actually started bringing, outside money. And I think that says a lot. He really wanted to get a good product before he kind of brought in other stakeholders. And so for me, that.
Because I think they were offline for 4 years before launching their first solution. Yeah. What about Appian?
Appian, it was just the way Matt Cock. The other pattern is that I like. Most of these CEOs I'm investing in are introverts in a way, and they think in terms of patterns. So I see them kind of as. They create environments, and so when I was reading about Matt Calkins, one of the things he's trying to create an environment where his employees are highly engaged. The same thing that kind of the same story where he kind of self-funded it, bootstrapped it. But the one article that really I said this is our person is when he walked away from his large option package when he was like 23 years old. That told me that he's not motivated by money, and so that kind of was what got me really interested to look into him more.
And we know that story of Jeff Bezos walking away from his big bonus at D.E. Shaw, just had to wait a few more months and he would have had a 7-figure bonus, and decided, listen, that's not the priority for me. For Jeff, it is the regret minimization framework, as I'm sure you remember or know. His view is to simulate lying on his deathbed and to ask himself whenever he's facing an important decision, what will I be proud that I chose to do in that moment when my life is toward its end? And he said, it won't be that I waited around for 4 months for a bonus when e-commerce was growing at 1,000% a month or something extreme in the very early period. He's like, I don't want to miss those 4 months, so I'm going to go. So you have Matt Calkins at MicroStrategy with a big bonus of equity sitting out there and saying, nope, I'm going to leave and start my business. What about Shopify?
This is kind of one of my favorite, and the reason is because I like CEOs I can learn from, so that's another pattern. And every time I hear Toby speak, it changes my way of thinking about how businesses should be run. So with Toby, I think what got me is that he really, his higher purpose and is that he wants to lower the barriers to entrepreneurship. So this is not about a product. This is about making it easy for people to compete with an Amazon, and being able to do it on an equal terms, and also taking away all the problems that entrepreneurs face that actually cause them to fail. Like the payments starting from there, that's a huge problem. But so he wants all entrepreneurs to be able to focus on their product, which is going to give them a bigger chance for success. And that's very much his purpose, is just lowering this barrier for entrepreneurship. And I just think that's a really cool thing. So I do own Alibaba too. That's one I forgot.
Of course.
Jack Ma.
Yeah.
So
and what happens for you when Jack Ma decides to
sell? Yeah.
Sell.
It's just a discipline thing. I sell. I think it's like a chef and a cook. Daniel Zhang is kind of a cook. He's not the chef. Same thing with cook at Apple. He's kind of and the thing about a chef is it looks like they're not doing much. But if you watch like a chef in a kitchen, it's just those little details that really make the company better. And he's got a different mentality than the cooks.
And so Tim Cook Yeah. And Apple has been an incredible performer.
Yeah,
I mean,
it has.
He's certainly delivered. But what is it about that caused you to say, still, my discipline would, even looking back, suggest that I not buy that stock?
Yeah, I think Apple's gone from being highly innovative to efficiency oriented. So that's one of my, and filters is that, I mean, if you look at Apple products today, there really hasn't been insane innovation. I mean, it's just they've kind of made things better or added a couple of features, but there's nothing like what you saw under Jobs. And it's just not criticized. He's just got a different mentality than Jobs. So he's more, at Apple, his role was always efficiency. How to make things more efficient. And so that's what he's doing now as CEO versus Jobs was let's get great products out there.
And so, of course, you're not suggesting that someone couldn't succeed by being an efficiency-focused investor, but why do you focus on the chef and innovation versus a series of awesome cooks and great efficiency?
I think you just have lower risk. When I invested in Jack Ma, I watched a documentary called Crocodile and the Yangtze. It's out there on Amazon. And here's a guy, this is beautiful because they're like filming Jack Ma when he was like a young guy, and he's like talking to a group of 20 people like, our purpose is to raise China and the small businesses of China on a worldwide scale. And so here's a guy being filmed. He had no idea who he'd become, but it's just something about these purpose-driven. It's just you have their framework, their decision-making framework is way different. When you frame it from every decision is framed. How do we make life easier for an entrepreneur to start a business versus how do we create a product? So, one of the things I look at is a lot of these efficiency people talk about how do we sell more to a customer. So I was looking at GoDaddy? Yeah, GoDaddy. Mm-hmm. And in the conference call archive, they're talking about selling more products to their existing customer base. And how can we do that? And if we sell $2 more, and that's a whole different mentality than Toby that comes at it from like, how do we solve the shipping problem for entrepreneurs, on their online business? So it's just a whole different viewpoint.
Could you give us a checklist by which we could evaluate a leader of one of the companies that we're invested in? So I know you wrote the book, The Investor Checklist. We'll talk about that in a sec. But what would be some items for somebody who's sitting out there saying, I really have no idea how I would determine whether the CEO of Appian is amazing, decent, or going to be a problem for that company. So what are a few items that we should focus on? Yeah,
I use the acronym IP. First, I want them to be intrinsically motivated. And again, I have a friend or an acquaintance named Mike Lombardi, and he used to work with Bill Belichick. And one of the stories I love that he told me about Belichick was that he said, if you watch him carefully in films, and I'm not a big football fan, but he said, if you watch him in films, if they score a touchdown and he didn't feel they did a good process, he would frown. And if the other side scored a touchdown, but they did good, he would smile. And so he said, and he always would convene the coaches after a Super Bowl win to go over what they did right or wrong. And so he was motivated by the process. Outcome-oriented is the opposite. These people are the ones that are motivated by money, prestige. You could simply sometimes Google their lifestyle. It's out there.
Yacht, the word yacht next to your CEO.
There's not too, that's kind of but if they have most of the CEOs I'm invested in, some live well. Bruce Flatt lives in the same, he's now a billionaire, he lives in the same apartment he's had in Toronto and New York for 20 years. Hasn't changed his lifestyle. There is a pattern. Toby has changed a little bit, but not. It's more like if they're out doing the charity circuit or the art markets, those kind of things tell me that they're more extrinsically focused. That they're the coaches in football. They're out for a win. After they're not going to convene their coaches after a Super Bowl win and say, hey, what did we do wrong and right? They're going to go drink champagne and get drunk, but there's something to that. So
you've done it's pretty interesting how you've traveled around and met with a variety of CEOs. How do you get those meetings, and what is happening in those conversations? Are you meeting with them in their office? Are you how do you spend the time that you get with leaders, and who are a few people you've met, and what impression did they make on you?
Yeah, good people are accessible. Most people don't go to shareholder meetings. I haven't gone to Amazon's, but I hear there's 40 people that go. I have a friend that goes every year. And the thing is, if you find out that they're on a board and there's another company there that's presenting, they're not the star of the show, you could go, they're accessible. Sometimes I'll send ideas or write them.
You'll write an idea to the CEO or to the investor relations?
What they're doing, not their investor relations, never. Just I'll usually meet them at the end, but it's good people are accessible. You can go to Brookfield's Investor Day. It's open to anybody. They don't say, hey, you have to be a certain size. They just say, whoever shows up, shows up. So you can have some one-on-one time there. So that's, I'm trying to, what's accessible.
Now, one of the findings of your work that I've shared at a couple talks in the past is what you discovered about the impact of parenting on some of the best chefs in the public markets. And what was it that you found, and do you still believe that to be true today?
Yeah, no, I do. And what happened is my partner and I, we were studying the best of the best. And just like what I noticed is, and I've been around a lot of CEOs, I'm like, there's something like their intensity is insane. I mean, they're just always on. They never chit chat with you. They just have this extreme level of intensity. And so we were like, why are they different than others that, I was talking to another CEO and we had a 3-hour conversation and he was like, well, I had good parents. And it was like, yeah, but you're also retired and enjoying life and traveling. And, why is it that person over there just keeps going and going? And we kind of stumbled upon it, but and it's basically they've all had this very bad childhood, a very traumatic. I mean, it's an extreme. All of us could say we had maybe a bad parent or something, but I'm talking a very extreme. Warren Buffett's mother would constantly belittle him. That came out, forever. Warren Buffett said I had great parents, and then when the book Snowball came out, his sisters kind of said no, she would belittle us, tell us we were worthless. And there's something I'm not, but if you look at history, I was just looking at Pope Francis's background. His mother did not want him to be a priest. And in fact, she didn't even go to his seminary when he was in seminary school. And so she, to her dying days, did not want him to be a priest. And so it was she was disappointed in him constantly. But they do, what the other side is they do have a mentor or somebody that, like, it was his grandmother that give them the positive reinforcement. We find, they're wired differently. You look at the siblings, Warren Buffett responded one way, his sisters responded in a completely different way. So we just found if you start paying attention, Leonardo da Vinci, name it, you start seeing this pattern that they had really.
That one of their parents pushed them or doubted them or treated them as incapable in important ways relative to what it is they wanted to do?
Yeah, not doubted. I think there was something wrong with the parent. Intrinsically wrong, like they had psychological issues. There was something wrong with Warren Buffett's mother that was psychological, and so you can't manufacture it. I can't raise my kids and one will become a drug addict, the other one successful. It's got to be sincere, and it's Walt Disney. His father would walk around the parks and go, this just shows me how stupid people are. That they go to this, and Walt put his dad's name in Los Angeles, and the dad was like, I don't want my name on this, like this is insanity, and so it's just kind of this.
So how do you evaluate that when you're with your 5 companies? I mean, who are you talking to about that? Do you go directly to the CEO and ask them? Do you give a phone call to their parents? Do you talk to the people around them, their friends and family?
I hate saying it unless it's public, I'll talk about it, but they all definitely have a function of this for sure. So I'm partnered with a research librarian, and it's unbelievable what she's able to find.
And I wanted to talk about that. It's very interesting what Michael did in his money management practices. Instead of hiring a financial analyst to work with him who has a background in studying businesses, you went and hired Anne and her background. And why did you make that hire? And what's the implication of that?
Yeah, I mean, the thing about librarians is they're into the fact business, and analysts are like ego, like they want their idea in the portfolio. But with Anne, it was like, she just kind of stated matter of fact, and so it was more fact-based, more rational. It wasn't about selling. It wasn't about a story. It was just, this is what happened. And so I think just that different mentality, we can be a lot more rational. And she's a gray thinker. I'm a black and white thinker. So we complement, each other quite well.
How many companies do you look at a year?
Well, we've looked at every publicly traded, but company, we have like a pass list. We look at them quickly. I can tell when I was reading about GoDaddy, it was just on my list, and I read a conference call archive, and I said, that's all I need to know. So we have a very high bar. That's the beauty of a concentrated portfolio. If you have really high comparisons, you're just basically like, is this... and this is a term I stole from your brother, Mount Rushmore type CEO. This is something I learned recently that just brought all our research together in some ways. Where
how many are familiar with David's Mount Rushmore idea? Good. Oh, let's hear about it.
So David basically made the comment, they were asking about Tesla, and he said, well, he's a great CEO, but he's not on my Mount Rushmore list. And we started thinking, Ann and I were like, wow, who's on our Mount Rushmore list here in our own portfolio? We ended up selling 2 companies, based on that alone. And it's just, if you have better criteria, it's like, I used to call it the perfect spouse theory. The better your spouse, the less, that you're looking around, or you've got it good. The grass is green on my side. Same thing happens with portfolio companies. It's a form of comparison. Like, is this CEO like Toby? No, gone. So we're able to filter through a lot of ideas based on that comparison.
I want to give you a minute just to advocate for Shopify. How many Shopify shareholders are in the room? Great. So Shopify makes up what percentage of your overall portfolio? Ballpark?
I think it's 20% now, but that's been through appreciation.
Yes.
And it's one of those things we never sell them. I've learned that when.
And you maybe a little bit about the company, but also maybe dig a little deeper about Toby and some things that you've observed about him.
I talk to a lot of the people that work at Shopify. That's one of our once we really get to know a company, we talk to the people internally. And, it's like little stories you hear about Toby. One, Toby's always trying to ruin his own company. So there's these stories of he goes out and into his server farms and pulls a server to crash his system. And it's so Toby is always thinking about, how can I destroy Shopify? And in a lot of ways, when you're partnered with somebody like that, I think just good things happen, and so and that's how I actually got to meet him. I said, oh, I'm a shareholder, and then he walked away from me, and I said, hey, Toby, I actually know how to destroy your company. And he turned around and he said, he started engaging. I had to come up with something very quickly, about culture, and engagement. I was like, didn't think you'd turn. But he's constantly thinking through this, and he's all about creating, there was a recent interview that Toby did where he was talking about autonomy and what that means. And what he was talking about is he wants people to bring themselves to work. And he contrasted that to Google, and he said, I'd hate to be googly. I'd hate to be in a place where I'm googly, on the googly scale. I don't know if you know about Google, but they have this googly scale, how googly are you? And Toby's I just want them to bring who they are. And so he creates the environment for that. And he has this thing called Trust Battery, which you've had interviews with him where he talks about it, where he's basically, when you get into Shopify, you're at 50%, and your actions and your peers get you to 80 or 90%. And when you get there, Toby's just what do you want to run? What area do you want to run? And there's something very empowering about that. And that's why that organization is able to scale so quickly, grow so quickly, solve problems more quickly. Rather than having this structure, he creates an environment. And that's the beauty of Toby.
I remember Toby telling us that in pulling the plug out of the server farm, for example, that they have challenges, for the next 2 weeks, everyone must move the mouse to the other side of their computer. And he just wants to create discomfort, get you out of your seat. John Mackey, move around, don't be sedentary. And Toby's constantly doing that to all of the people that work at Shopify to get them to think and act differently than they're accustomed to, or their habits are formed. My final question for you, you're 30% in cash. Raise your hand if you're more than 10% in cash. Awesome. So that's your tribe. There's your tribe. Talk to your tribe about reallocating that capital. what are the triggers that will cause you to reallocate it? Is it the finding of a next Mount Rushmore CEO, or is it about the market's valuation? What are one or two factors that cause you to say, I'm going to cut my cash position in half. I'm going to go from 30% to 15%, or out here, we're going to go from 14% to 7%.
So we prepare in advance is our whole thing. So we kind of know what we want to pay for a company. So at Atlassian, we'd like to pay a price that's 40% below. I don't know what it's trading. I haven't watched it in the last few days, but 40% below kind of what it was when I came into this conference. So we prepare in advance, so the decision's already been made. And so there's a lot of companies that we kind of have these price targets that we're just waiting for. And when it hits that price, that's kind of when we start at a 5% position, so it really has to be at this kind of really good a price that we feel we can double our capital.
So you'll never have more than 10 or 12 companies in your portfolio?
I'd like to, but it's just a function of again, opportunities. But sure, I'd be happy to have that many opportunities of Mount Rushmore, but it's just not that many of them.
I recommend Michael's book, Investor Checklist. It's published in 2011. How much of that 7 years later is current thinking of yours, and what percentage of that book has changed in how you think about it?
Yeah, I don't recommend it.
That's so good. He does not recommend his book.
Unless you really want to get bored.
I definitely recommend the idea of an investor checklist, but why don't you recommend it?
Well, no, I wrote it for me when I was 21 years old, somebody entering the business. So from that standpoint, but it's just looking at a business holistically. But I would say a lot has changed. There were some patterns in there, but they weren't fully formed beliefs. I think leadership is the biggest. Leadership to me is the one thing that if you study, you can predict. It's the only thing that's predictable. The actions that the leader's taking today is what's creating value 2 or 3 years from now. So like Toby doing the shipping, it doesn't look like a lot, but it's going to create a lot of value down the road once he solves this problem. And so we're looking at leadership decisions today, and so that's where it's changed. It's all about leaders for me, and less about studying the footnotes and these other things.
Well, that book got you to where you are today, and it could help others get to where you are today with great investment returns and a discipline that has us now learning from you.